Good afternoon. Very sorry about the slight delay there. Thank you very much for joining us at the BetaShares Quarterly Economic Outlook with David Bassanese. Before we start today, I need to remind you that the information contained in this presentation is general information only, does not take into consideration any personal needs or circumstances, and before making any financial decisions, you should consult your financial advice professional. A reminder that a recording of the webinar and the presentation will be emailed to all attendees following this event. If you do have any questions for David throughout the event, please use the panel on the right-hand side of your page, and David will look forward to answering your questions at the end of the webinar. So without further ado, I'd like to introduce David Bassanese. Many of you will be very familiar with David. Obviously one of Australia's leading economists. He makes regular appearances and is often quoted by the Australian Financial Review, the Australian Financial Review, Sky Business and ABC News. So welcome, David.
Thanks very much, Sarah, and thank you all for joining us today. I think it's going to be a pretty interesting discussion. What's been happening in the last few months. But the way I'm going to break it up today, there's three sections. So firstly, let's look at what's happening globally, so the international market outlook. Then peer into the Australian economy with the Australian market outlook, and then what all this means in terms of investment ideas in the current environment. So with that, let me turn firstly to the international outlook. And obviously the first big issue in global markets, sad but true, is Donald Trump. So I guess one major theme over the last few months is the Trump trade. Basically, the Trump trade from late last year was confidence that, Donald Trump would come to power and unleash fiscal stimulus, which would further support the US economy, push up global bond yields, push up the US dollar, and further enhance the growth in equity markets we've been enjoying. So basically, 2 out of 3 of those haven't worked. I mean, bond yields in the US dollar since the start of the year have actually come back somewhat. So the good news is that equity markets have continued to push onwards. So 2 of the 3 trades haven't worked, but I still think that definitely will play out over the next year or so. But the equity market has basically shown us that it didn't really need the fiscal stimulus that Donald Trump was promising, given that the US economy is still doing quite well, corporate earnings are doing quite well, inflation is under control, interest rates are low. So, I mean, just going through some of the concerns he said, obviously the health reform failure shows that he, wasn't able to get a lot, his ability to get stuff through Congress has been questioned. There's been a lot of staff changes, ongoing Russia probe, and more recently the debate over his handling of the Charlottesville riots of last week. But markets so far have been pretty forgiving of Donald Trump, it's fair to say. I mean, he causes some consternation on a day, but is quickly forgotten the following day. And in fact, markets even now are starting to get excited again about talk that he may soon be bringing forward his tax bills, and what that would mean for the economy. But let's look at, basically Donald Trump aside, in terms of the US, the good news, I've got 2 charts there. The first one is the unemployment rate and wage inflation. And, the economy continues to grow well, punching out pretty good employment numbers. The unemployment rate in the US has now dropped to 4.3%, continuing the steady decline we've seen since the end of the GFC back in 2009. Wages growth, if you look at the blue line there, it did start to pick up over the last few years, and up until recently it looked like it was continuing to rise, which is what the Federal Reserve in the US did want to see. But in fact, it peaked at around 2.7, 2.8% a few months ago, but since then it's actually slowed back down again. So just when we thought inflation was starting to take off and wage inflation starting to take off in the US, it's eased back down. And that's also been seen in the inflation numbers. So that the second chart there is consumer price inflation. And again, in February this year, the CPI got close to 2% year on year, which is what the Fed's target was. But since then, it's actually eased back off again, which has led to some consternation amongst Federal Reserve officials and markets questioning whether or not the Fed will be all that aggressive in terms of raising interest rates this year. And just got a quote there from the last federal minutes from the last Fed meeting, where basically the committee said they will carefully monitor actual and expected inflation developments over the next few months. And basically, if you look at the markets now, there's only a 30 to 40% probability priced in for a December Fed rate rise, although the Fed expectations at the moment is that they will raise rates in December. But the debate is, if inflation doesn't pick back up in the next few months, whether or not the Fed will proceed with that interest rate increase, and in fact what they will then do next year as well. Because at the moment, the Fed projections, if you look at the Fed, their quarterly publication comes out, and they have what the members on average expect the federal funds rate will do over the next year, and that's got 3 to 4 rate rises still penciled in for next year, whereas the markets at the moment are basically pricing in, barely pricing in 1 rate rise next year. So the markets are of the view that low inflation will mean the Fed won't be that aggressive in raising rates. What we do know is all the talk so far suggests the Fed will begin its balance sheet rundown at at its next meeting in September. So that at the moment so that will mean that as bonds in its $4.5 trillion portfolio mature, it won't replace them, and so start to let its huge holdings of bonds that it's built up over the last few years start to run down. So I think that's still on track. The debate at the moment, though, is what it does with interest rates and whether or not it will raise rates in December. Just on that, I mean, a big event coming up is a speech by Janet Yellen at the Jackson Hole conference. It's a conference of central bankers on Friday, and the markets are seeing if she'll provide any signal in terms of, that interest rate question. So that's where the US is at the moment. Basically, it's still things are still going along pretty well. And if anything, there's a risk that the Fed does less rather than more in terms of interest rate increases in the foreseeable future. Elsewhere around the globe, I mean, other good news, Europe and Japan have just got some GDP numbers there. Japanese economy actually grew by 1% in the June quarter, so 4% annualized growth. It's in fact grown now for 6 consecutive quarters, which is the best performance in over a decade for the Japanese economy. Europe has also picked up growth in the last few quarters and had 2.4% annualized growth in the June quarter as well. And consumer spending, business investment, they've all been contributing to improvements in those economies over the last 6 months or so. Notably, in both these economies, along with the United States, inflation is still lower than they would like. So although we're seeing good growth, unemployment declining, central banks, rightly or wrongly, are still, obsessed about the fact that inflation is not as high as they would like. So they still retain, they're still reticent to sort of begin to tighten up monetary policy all that much. Japan is still adamant that it's not going to be, it's still buying up heaps of bonds globally. It's still targeting a 0% yield on its 10-year government bond. And in Europe, there's tentative talk that will start to reduce its bond purchases at some stage next year, though ECB President Mario Draghi has made no commitment to that at this stage. He also does talk on Friday at the Jackson Hole conference, but at the moment, the sentiment is that given despite the strength in the euro economy, the strength of the euro currency against the US dollar over the last few months has made the ECB reticent about tightening policy. So he's not going to provide that signal at the meeting. In the Chinese economy, things are also going along pretty well. China had a growth target this year of 6.5% GDP growth. in the first half of the year, it's actually grown at 6.9% annualized rate. So it basically can afford to slow down a little in the second half of the year and still meet that target. Just got some of the monthly, key monthly indicators: retail sales, industrial production, fixed asset investment, and more or less, going along at a pretty steady pace. I mean, there are month-to-month wiggles, but annual growth in all of these measures has been fairly steady in recent times. So, no real dramas in terms of the Chinese outlook. If anything, and that's to be expected because there's a major leadership conference later this year where there'll be a handover over power, and Chinese officials generally like to have a very stable, well-performing economy in the lead up to that conference, which happens every 5 years. So I think that there will be pretty stable environment in China leading up to that. And then and next year they may start to think about tightening up policy again, because a lot of the growth they've seen of late has been in housing construction, infrastructure projects, and there's some debate about whether they really need to be spending, basically, are they building too many houses? Are there too many infrastructure projects? There's still a question of whether the balance is right for the Chinese economy. But in terms of what it means for us, it's still pretty good outlook at the moment. And so fears about China imploding, still pretty far-fetched and unlikely to happen anytime soon. I guess the one big geopolitical risk, of course, is North Korea. Don't really have much to add here. I mean, I'm not a geopolitical expert to know, how Donald Trump and North Korea this is going to pan out. Though what I would say is that what we've seen over the past week is that North Korea, having threatened to launch missiles near the islands of Guam, didn't do it. So they did back down. And so far, at least, it's been North Korea that have blinked. And perhaps, under the strong rhetoric from Donald Trump saying, there'll be fire and fury, quote unquote, if they were to do anything like that. So that is still a standoff. The hope is that, well, the fact that they did blink this week does suggest North Korean leadership aren't as crazy as, many fear, and maybe there is hopes for diplomacy sorting this out over the next few months. Though, obviously that is a major event risk how that does play out. What about markets? This is my long run chart of US equity market valuation, so the PE ratio versus 10-year government bond yields. What I can tell you is at the moment the price to earnings ratio for the S&P 500 is about 17.5. The longer run average is closer to about 14, 15. So yes, as everyone says, the market is expensive on an outright PE basis. But given where bond yields are, if you modelled the sort of the relationship there, fair value, looking at that long run relationship, would have the PE ratio around 17. So we're actually very close to fair value, given that US 10-year government bond yields at the moment are very low. They're still, at the moment, as I speak, 2.2%. So, that's what's pushed up that PE ratio. What I would also say is that as bond yields do rise, I mean, and my forecast is that over the next year to 18 months, bond yields in the US will rise from around 2.2 to about 3%. But even at 3%, that's quite low historically, and would be consistent with a PE ratio only falling from around 17 on a fair value basis to around 16, which is still above its long run average. So downward pressure on the PE ratio, but it can still remain relatively elevated by historical standards, given that bond yields are likely to still remain pretty low. Other good news in terms of the markets, forward earnings. I mean, this is when you talk about a PE ratio, obviously the P is price and then E is earnings. So this is forward earnings for the major markets globally. If you look at the orange line, the US, it's had a pretty strong recovery coming out of the GFC. After a bit of a wobble in 2015, 2016, earnings have picked up again over the last 6 months or so. And importantly, consistent with what we're seeing in their economy, earnings growth in Japan and Europe has also picked up quite nicely over the last little while. So again, further, good news for the global economy there. Again, if you would actually just sum up what's happening globally, I mean, this is, the title of the talk is Goldilocks. What we're seeing is, reasonably good growth in the global economy, but an absence of inflation, so that central banks can remain, basically keep the punch bowl at the party, not needing to get, not needing to become too restrictive too quickly. So what we've seen is after a big sell-off in bond yields with the Donald Trump becoming president late last year, if anything, 10-year government bond yields have been easing back this year. The US dollar has also eased back this year, if you look at the two charts there. But meanwhile, the S&P 500 has basically continued to push on. So that's been it's been able to certainly withstand the fact that it hasn't had a lot of fiscal stimulus from Donald Trump. Gold prices have pushed up also on the back of the US dollar weakness. Oil prices, in terms of a key commodity, still range bound. I mean, OPEC have tried to cut back production. OPEC have cut back oil production, but that gap has largely been filled by US shale oil producers, so that if anything, there's still an excess of supply in oil markets at the moment. So commodity prices still pretty soft, and gold, benefiting from the weakness of the US dollar. What about the Australian market? First point I'd note is what's an interesting gap, a so-called gap between hard and soft data. So the orange line there is the National Australia Bank Index of Business Conditions. So it's a monthly survey that comes out and basically asks businesses how how business is going. And what we've seen over the past year or so is that's basically continued to push up, and now is at pretty good levels. It's actually at the highest levels. It's back to the level, that we were prior to the GFC, so basically back in 2006, 2007. Whereas meanwhile, GDP growth has remained quite weak. In fact, trend growth in GDP has been only around about 0.4% over the last few quarters. So basically a 2% annualised rate of growth for the economy in terms of GDP. So that's an unusual gap. The question is, how will that get resolved? Will it be, business confidence coming back down again, or GDP picking back up? Probably going to be a combination of both, but I think the GDP, I see, will pick up probably at around 2.5% or so, but it's certainly the outlook is unlikely to sort of get anywhere near the sort of 3 to 4% pace that business surveys suggest it should be at. Just going through some of the, I guess, interesting aspects of the economy at the moment. The unemployment rate. Again, what we've seen this year is the labour market has remained pretty solid. So far this year, we've had 167,000 new jobs in the 6 months to June, versus only 34,000 jobs created in the first half of last year. So a pretty good employment growth. Unemployment rate has dropped back down to, as of July, 5.6%. From a recent high of 5.9% in February. And also what we're seeing is a lot of growth in the last few months has been in full-time employment rather than part-time employment. What's driving this? The health, basically so-called secular, I guess, long-term underlying healthy growth in areas such as healthcare and education. Also, the construction area is still doing well, so home building, housing construction. And, state governments, a number of infrastructure projects in the road, rail and energy areas are also contributing to growth. So we're seeing quite broad-based sources of demand in terms of employment at the moment. Not really showing through to wages, which is another story, but I'll talk about inflation in a moment. The other area of the economy, building approvals, a major swing variable. And if you look at that chart, I mean, clearly building approvals, this is home building approvals, are off their peak. But if anything, so far this year they've tended to stabilise somewhat. So it's again good news for the economy. We're not seeing building approvals, fall in a hole, hold up pretty well. But going forward, they are still at a relatively high level, and the outlook would be that they will continue to, I guess, gradually fall over the next 6 months to a year, and that home building approvals are still higher than needed given underlying population growth. And we're seeing, high-rise apartments that are being completed in areas such as Melbourne and Brisbane, to some degree Sydney, Vacancy rates are lifting, the rents being demanded are being reduced. So you are starting to see some softness creep into those markets. And I think, those looking to launch new high-rise apartment developments may find, the demand conditions not as conducive as they were, say, 2 or 3 years ago when the current building plans were developed. So that is going to be a big challenge for the economy next year, in that, building, again, it's been a theme that I've talked about in recent quarterly seminars, and this is, it does remain a feature, is what will fill the hole as housing drops away over the coming year. In terms of the property market, you can basically look at house prices. I mean, there's really 3 separate markets going on at the moment. So you've got Sydney and Melbourne, where house price growth does remain quite firm. In fact, the last few indicators in June and July suggest, house prices are still ticking along reasonably well in those markets. What's helped of late, for example, in New South Wales, for example, this government under pressure to be seen to be doing something about housing affordability, cut stamp duty faced by first home buyers. So surprise, surprise, you've had more first home buyers back into the market and basically adding to the upward pressure on prices. So most economists think cutting stamp duty for first time buyers is a bit of a silly idea, because it basically is a win-win for people selling property, not buying property. But there you have it. The political realities are is that politicians need to be seen to be doing something, and that's what they've done. So Sydney and Melbourne have held up somewhat of late. Perth is still struggling through the post mining boom slump, so that's still quite weak, and the rest of the capital cities somewhere in between. Tentative signs: auction clearance rates in Sydney have slowed in the last few weeks, so they were at a peak at around 80% a few months ago. The last few weeks of the auction clearance rates have been around 70, 65%. So if that holds, it is consistent with some of the heat starting to come out of the Sydney market. So, what about our market in terms of valuations? Sorry, I'm getting ahead of myself. Consumer spending's also been reasonably good of late. This is a monthly chart of retail spending. You can see after weakness earlier this year, the last 3 months readings of retail sales have been quite solid, such that retail sales volumes look like growing by about 1.4% in the June quarter, after virtually flat growth in the March quarter. So overall, though, consumer spending is, I would still classify as patchy. I mean, we get one good quarter of growth, then followed by quite weak growth, and overall it's still fairly subdued, you'd have to say. Though just when we thought retail spending was dead in the water in the first few months of this year, consumers have basically staged a pretty feisty bounce back. They've still managed to find some money in their wallets to spend. So that's, I guess, somewhat heartening. What about inflation? This is the measures of underlying inflation from the Reserve Bank. And again, up until a few quarters ago, underlying inflation was at 1.5%. If you look at that chart, it has actually edged back up close toward 2%, not quite there. It's at 1.7, 1.8% at the moment. Though annualized, I guess if you look at the quarterly growth in the last 2 quarters, the March and June quarters, annualized it's been 2%. So it's been enough to start to drag up inflation from 1.5 toward 2. Remember that the RBA's target is to have inflation around 2 to 3%. So if it gets inflation in that band, it will be somewhat more happy, with things, and less likely to want to cut interest rates. So the question going forward is, will it actually push on beyond 2%, or will it stabilise at 2%? And my thinking is that it's probably likely to, in fact, level out at around current rates than push on further. So I think, again, the RBA is going to be a bit frustrated with inflation over the coming year. Reasons for that: wages growth remains quite weak. Annual growth in wages is only around 2.5%. You've got strong competition across many sectors: retailing, energy increasingly, although electricity prices in general have picked up. And the Australian dollar has also strengthened of late, which I'll touch on in a minute, which is going to put downward pressure on import prices. But inflation is contained, though I think, and it has lifted, though it's going to be contained and probably still going to remain lower than what the RBA would like over the coming year. Other features of the economy, iron ore prices. So this is the spot iron ore price. And if you just look there, I mean, the big feature last year was that strong rebound in iron ore price from around $45 a tonne US up to around $90 a tonne. That underpinned the very strong rebound in the resources sector last year. This year we've had a bit of a yo-yo. We had a big slump in the early part of the year, and just when we thought, you know, iron ore was dead again, it staged a rebound in the last month or so. So it's basically a yo-yo. It's very hard to track short-run gyrations of iron ore prices, particularly because it's a bit of a plaything by Chinese retail investors. The futures price is something that Chinese investors can actually actively trade on a day-to-day basis. It does tend to make it volatile. But fundamentally, you know, the outlook is that prices are going to, I think, go still more likely to go down than up, but still remain in this wishy-washy range for a while. But in fact, the official government forecaster has iron ore prices next year at $48 rather than $78, because although Chinese demand is holding up, you've still got ample supply coming through, not only from Australia but also from Brazil. So the markets do look well supplied, and prices should be coming down, though it's certainly doing it relatively slowly. Australian dollar, I guess the big news of the last few weeks is that having been in this mid-70 cent range for a long while, it pushed up and actually touched 80 cents briefly a couple of weeks ago. A couple of reasons for that. As I mentioned, the Federal Reserve have started to question whether or not they will be aggressive in raising rates this year, given inflation in the US has been quite low. So those Fed minutes that I referred to earlier were really a catalyst for the Aussie dollar pushing up. The rebound in iron ore prices of late have been a further positive. A more of a short-run factor was that briefly a few weeks ago, markets thought the RBA had hinted that it was going to start raising interest rates. That turned out to be basically a misreading of what some of the RBA comments were. At the time, I said the market had got this wrong, you know, follow-up from the RBA basically confirms that. The RBA basically is on hold for the foreseeable future. It's got no interest in raising interest rates anytime soon. But Aussie dollar's still held up closer. It's around about 79 cents at the moment. Looking at the economic forecasts. So again, last quarter I mentioned the RBA had a growth forecast of 3% for 2017, and I thought it was likely to get closer to 2.5%. The last set of RBA forecasts have now actually lowered growth to 2.5%, sort of more consistent with where I was at. And you know, my forecast remains unchanged. I still see growth, you know, around about 2.5% this year, and not much upside next year as well, particularly with the housing sector acting as a drag on growth. So again, that's going to be, so the RBA and I agree for this year now, but the RBA is still a little bit more optimistic than I am for next year. They see growth picking up to 3%. So we'll see who's right next year, but that's my call for the moment. And again, inflation, I still think it's struggling to push up beyond the band. So my target would be about 1.8% year-on-year growth for this year. Pretty stable, nudging up close to 2% next year, but again, that's still less than what the RBA would like. And I also think as the growth does hold around a 2.5% pace, that the strength of the employment market that we've seen will start to taper, and the unemployment rate will hold probably, you know, the wrong side of 5.5%. So up around about 5.25%, 5.75%, rather than pushing down toward 5%. So that is a backdrop for the RBA to remain on hold for the foreseeable future. You know, certainly no rate rise before, say, the second half of next year. But if my forecasts are right, it's even hard to see them raising rates in the second half of next year as well. What about the markets? This is basically the way I track earnings expectations in our market. So what this is what the current market estimates for forward earnings as of the end of December this year would be and how they would track over the year were the historic revisions to earnings, were they to pan out in line with history. What we're seeing, what has actually happened so far, if anything, earnings growth has been revised up since the middle of last year, and that's on the back of the strength of iron ore prices. So in the last few months, the expected level of earnings by year end have actually come back down again somewhat. So the sort of typical downgrade to earnings expectations that we see have started to kick in. So I'm sort of penciling in a likely estimate of around about 360 for forward earnings. That's just an index estimate, not very far from where we are at the moment. So basically this suggests little growth in forward earnings for the rest of this year. In terms of 2018, again, it's very early days in terms of knowing where earnings will grow. I'm being generous there, and let's say it tracks close to where it currently is, and that'll give you 380 on the index, which would be about 5.5% growth through next year. But overall, earnings growth in Australia, unfortunately, is not as solid as we're seeing in other markets, which is, again, one of my key investment themes in terms of where you would see growth opportunities. In terms of valuations, what does that mean? Again, very similar to the United States. So given where bond yields are, our market is actually close to fair value. So the PE ratio at the moment is about 15.5. Long run average is 14. But given that bond yields are around about 2.6%, fair value is about 15.5 on a PE basis. So, again, close to fair value. If also bond yields do rise over the next year or so on the back of the US tightening interest rates, let's say 10-year bond yields in Australia get to 3.5%, fair value for the PE ratio would be closer to 15 rather than 15.5. So yes, it will put downward pressure on the PE ratio though, but not by enough to push it all the way back to its long run average. So again, that's I guess good news for our market in that we shouldn't require a major valuation adjustment over the next few years as interest rates rise, though PE ratio will be a negative factor, and that would need to be offset by decent earnings growth. Excuse me. So what does all this mean? Penciling in the financial forecast, as I said, I basically see the RBA on hold. The currency at 79 cents, I still think it's more likely to go down than up from here. It's just on a real long run basis, it's pretty overvalued at around 80 cents. I still think the Fed will actually raise rates in December. We'll see what Janet Yellen says in a couple of days' time, but my sense is that even if inflation does remain low, the Fed will decide it still needs to raise rates, lest it will get worried about creating asset price bubbles, letting the equity market just get too strong ahead of steam. So I'm calling the Fed to raise rates in December, and also to raise rates at least a couple more times next year as well. So that's going to put downward pressure on the Australian dollar. And if official forecasts are right and iron ore prices head toward $48, that will push the Aussie dollar down as well. Interest rates, bond yields pushing up on the back of the US, and our market basically is still pretty range-bound market. I mean, we've got moderate growth in earnings there, and basically the PE ratio coming down over the coming years, a little bit. But so one offsetting the other, basically keeping our market fairly range-bound. I guess one thing to watch, I mean, I'm not negative on equity markets, I think, at the moment, as you can probably guess from the commentary. What I've got here is a chart of the earnings yield to bond yield ratio in the United States. And as I said, the markets are close to fair value. If you look at that ratio, at the moment, that bond yield, the earnings yield to bond yield gap is about 3.5%. Long run average is about 2.5%. This is going back like 30, 40 years here. So we're still above that very, very long run average. And in fact, I guess what I wanted to highlight is if you look at the last few major bear markets over the last few decades, they've usually come at a time when that ratio is narrower than it is at the moment. So in when the market peaked in 1972, the gap was 1%. In 1987, the gap was minus 2.5%, so the earnings yield was actually below bond yields. And similarly, in 1999, during the when markets got pretty overvalued as well, the gap was minus 2.4%. In 07, just before the GFC, the gap was 1.6%. So overvaluations wasn't an issue during the GFC. What happened then, obviously, was the credit crisis that hit financial markets, which then impacted on the economy, but it wasn't valuations per se. So anyway, valuations are at a level now which in and of themselves shouldn't suggest the markets need to correct in a major way. They're certainly, quite reasonably valued given where bond yields are. And in fact, going forward, I mean, one scenario here is if the Fed does remain quite gradual, even with, one rate rise this year, a couple of rate rises next year, bond yields don't rise by that much, that gap could narrow and the PE ratio could actually keep rising. And so, the PE ratio in the US at the moment is around 17.5, as I said. In this benign Goldilocks environment, it could keep rising. It could go to 18, 20, and that's something the Fed will eventually get worried about. But, there's nothing to stop that market pushing out that valuation at the moment, given the current benign outlook for the global economy. So what does this mean for investment themes? I guess one key theme is Australia for income and global opportunities for growth. If you look at the chart there, I've got the forward earnings, basically earnings for the different markets, United States, the world MSCI index and Australia. You can see the earnings growth has generally been stronger, certainly since the peak in commodity prices in 2011, outside of Australia, and particularly in the last year or so, we did get a bit of a bounce in earnings thanks to resources last year, but the bounce in earnings elsewhere has been notably stronger. So our market, we offer a relatively good dividend yield. The banks pay good dividends. There's a lot of utilities and those sort of companies that offer good dividends. If you want income, Australia's the place to be. But if you want growth, at the moment, in terms of major themes, it's international is where one needs to go. So what are some of the local income ideas? In terms of our suite of products, financials, I mean, I know many people own banks. If you wanted a simple product just to own the whole financial sector, is our ETF QFN, which tracks the ASX 200 financial sector. The gross dividend yield over the past 12 months is about 7% on that ETF. So, not a bad return just from owning the overall financial sector. The other one many of you will be familiar with, Dividend Harvester, HVST. Again, the gross income yield over the past 12 months is closer to 15%. I'd say that is a good income, though that is offset somewhat by some, it tends to produce less capital return than what the market would produce due to the nature of the dividend rotation strategy in that fund. But there's another opportunity. YMAX is another one. That's our covered call. Basically, we own the market, but we sell calls to pick up extra income. So you get basically extra income in exchange for giving up some potential upside should the market rally strongly. But the 12-month gross dividend yield on that fund up until end July was 10.5%. So pretty attractive dividends there. And also just to alert you to the fact that we have recently launched one of our first fixed income ETF covering bank floating rate bonds. And that offers a yield to maturity at the moment of about 2.5%. Again, not fantastic compared to owning bank equities, but it's the credit risk is less, the capital volatility is a lot less, and it certainly gives you a better yield than, say, some of the cash term deposit alternatives around there. So something to bear in mind. But in terms of where opportunities globally are, Goldilocks economy favours growth areas like technology. So there's just the Nasdaq 100 and its relative performance to the global MSCI since the GFC, and you can see it's been one of the big outperformers, and no signs yet of that outperformance diminishing. And if I had a single theme to share with you today in terms of global opportunities, it would be US technology, despite all the the talk about overvaluations and whatnot in some of those companies, which I'll mention in a minute. But in an environment of good growth, low inflation, low interest rates, growth areas like technology are going to do well. And so again, if you're interested in that idea, the Nasdaq ETF is the one that we have. NDQ is the code. Also note that this ETF is unhedged. So basically it's in US dollars. So if I'm right and the Aussie dollar does fall from around 80 cents at the moment, you also get an extra exchange rate benefit from holding that ETF. So yeah, Nasdaq 100 ETF NDQ. Looking at valuations, and again, if you read the papers, there's a lot of talk about, the sort of the Facebook, Amazon, these sort of companies being overvalued. If you look at the Nasdaq 100 overall, the PE ratio at the moment is 20. Long run average is 24. Its average since 2003 has been about 20. So at worst, it's close to its average since 2003, and it's certainly well below where we got during the dot-com bubble during 99, 2000. So you wouldn't say the market's cheap, but certainly relative to interest rates, it's cheap. Relative to its own long run history, it's sort of fair value, and earnings growth in that market is still pretty solid. So we're certainly far from a dot-com bubble. The other thing to note is that as talk of Donald Trump's tax reforms come back to the fore, one of those planks is to encourage companies to repatriate profits. I mean, regular listeners to my webinar, this is something I've talked about before. But again, it's just worth taking note of, given that there's now new talk in Washington of the tax package seeing the light of day. If they do encourage companies to repatriate profits from offshore, the key sectors to benefit most will be information technology and healthcare, which are fairly highly represented in the Nasdaq index. So the Nasdaq is going to particularly benefit from things like share buybacks, increased dividends, if companies bring more money back from offshore. Another global theme, Japanese equities. I actually just put out a blog on this this week. So if you subscribe to our weekly newsletter, you would see this as a blog posting. As I mentioned earlier, the Japanese economy has been doing pretty well of late. Corporate earnings have also been doing pretty well. And if you look at valuations of the Japanese market, it's actually relative to the MSCI or the world equities, it's looking pretty cheap. So longer on average, Japanese market usually trades at a 20% premium to global markets on a PE basis. And that's because interest rates in Japan are very, very low compared to the global average. But at the moment, it's actually close to the very similar. In fact, it's only trading at a 4% premium. So relative to global markets, Japan does appear cheap at the moment. And I just make that point that, earnings growth has been quite good. Value. And in fact, on a PE ratio, at the moment it's about 16.5, which is close to its long run average. So on an outright PE basis, the market is certainly not overvalued. Another feature, if I'm right, in the US dollar, the other, I guess, investment theme, but is also relevant to Japan, is the US dollar. So again, this is a long run chart of the real US dollar index. You see, we had a very strong run up over 2014-15, petered out, and then had a further leg up with Donald Trump's election last year. Since then, it's come back off. But if you look at it from a big picture point of view, I still think we're only midway through what is a multi-year uptrend in the US dollar. The US economy is still the strongest, most dynamic in the world. The Fed is still going to be raising interest rates more aggressively than that in Europe and Japan over the next year or so. So I think I still think that favours a stronger, not weaker US dollar going forward, although it certainly had a decent correction so far this year. So again, some opportunities there from a currency ETF for our USD and our Yank ETFs, if you just want some foreign currency exposure. But also areas like Japan and Europe, Japanese and European equities will do well, relatively well, if the US dollar is strengthening. The other theme, bond yields. Just want to emphasize here why bond yields are pretty low, but if anything, probably going to edge up rather than sink lower. So this basically looks at US 10-year bond yields as the light grey line. The dark line there is the forecast from economists in the US, the blue chip, economists, their 10-year forecast for the average cash rate over the next 10 years. And at the moment, they're saying that it's going to average around about 2.5%, which is pretty reasonable. We're at the moment, we're about 1%. The Fed eventually thinks a normal cash rate is around about 3%. So to say it will average, say, 2.5% is a reasonable estimate by, most economists. So given that, the effective term premium on 10-year bond yields is 0, because at the moment, US 10-year bond, well, in fact, it's a little bit negative, because US 10-year bond yields at the moment are around about 2.2%. So you're actually getting no yield premium for holding longer-term government bonds, given that on average cash is going to average 2.5%. So it just shows you that bonds are expensive and likely to push up. So the term premium, let's hazard a guess, the term premium should equal sort of what it averaged in the years just before the GFC, which is around about 0.5%. So fair value for US bonds is closer to 3% rather than 2.2% at the moment. So one area I haven't mentioned, global banks. Again, BNKS is the code there. That when and if bond yields do stage a turnaround again, global banks will be one of the sectors that will most benefit from that globally. And I haven't got the chart in this presentation, but it just shows the relative performance of global banks. It does do quite well when bond yields are rising. So just to reiterate, BetaShares now has over 40 funds, 40 different exchange-traded and managed funds available through the ASX. So I've just given you a taste of what I think are kind of interesting exposures given the current environment. But, there's lots of different opportunities out there. Just to summarise, these are, in terms of the themes, income in the local market, favouring our more our income-focused products. The Goldilocks global economy favours growth areas like technology. The broadening of growth that we've seen over the last 3 to 6 months in Europe and Japan does favour those equity markets as well. And a rebound in the US dollar and bond yields after what has been a pretty decent correction in both of those so far this year will favour the US dollar ETFs and global banks. So I hope you've managed to find something of use in that presentation. Overall, look, I think things are going on pretty well. Obviously, North Korea, Donald Trump, there's always things to worry about, but the big picture is, global growth is continuing along reasonably well, and plus it's broadened from the United States to Europe and Japan. Inflation is not rearing its head in any major way, so central banks can afford to be quite cautious in withdrawing the punch bowl. And so that, that favours the equity markets, still going up, albeit with, corrections here and there. But the outlook at the moment still looks pretty reasonable to my mind. I'll leave you with those things to keep in mind. Obviously, read the PDS, product disclosure statement for funds you're interested in investing in. Seek some professional advice if you're before investing. Obviously, this has just been general advice. And obviously investment returns are uncertain. Things, not everything that I anticipate or others anticipate necessarily pans out. So, it stays to be alert. So with that, I thank you very much for your time. And also just alert you, Tara, before I conclude, if you're not subscribed to our website, we put out a weekly newsletter, just a one email, that has some blogs, one from myself and one from another member of our team on a weekly basis. And also, I put out what's called Bassanese Bites on a Monday morning. Very short email, 500 words or less. Basically summarising what's been happening in markets over the past week and what are the key events to look out for the coming week. Short, sharp. And those that do get it, I'm getting good feedback from it, so thank you very much for that. Just gives you a good heads up in terms of what's been going on in the market. So keep those in mind. Also subscribe to us, LinkedIn, Twitter, Facebook. You know, we're in all the usual places.
We certainly are. Thank you very much, David. We've got some time for some questions, and there's quite a few. So if we just start, I guess it's a broader comment, your sort of outlook or expectation of the cash value of dividends from the market, and obviously the impact on our funds, Harvester and WineAct. Do you expect these to decrease significantly for the remainder of the year? Dividends.
Look, there have been some companies that have announced dividend cuts, obviously Telstra being the most obvious. The banks in the main have held their dividends. I mean, so I don't think we're going to see dividend cuts from the banks. In fact, you know, the APRA, I mean, again, one thing I didn't mention, but the one, I guess, risk factor facing the banks has been what APRA would decide in terms of raising the capital ratios for banks. They have announced that they would like banks to lift their capital ratios a little bit further over the next year or so, but not by enough that would cause banks need to go out and issue a lot of capital, and in fact they can meet a lot of that capital requirement through dividend reinvestment programs and whatnot. So that's been pretty good news for our banking sector. So no, I think, you know, if anything, the income yield available from our market has been relatively stable, you know, in net terms around 4.5%, 5%. And I'd expect that to continue.
Thank you. There was actually quite a lot of comment around the property side.
Sure. Four Corners?
Yeah, actually, yes, there was a question, and relating just to whether the market has already sort of priced that in at quite a bearish sort of outlook.
Look, let me just comment on like for those of you who may have seen the Four Corners. I actually thought the Four Corners report was pretty woeful, actually, pretty one-sided. The central premise of that story, if you saw it, is that dodgy lending around the country by brokers has fueled an asset bubble, and you know, prices are dangerous. We're all over leveraged, and prices are dangerously high. What I would say is there are definitely examples of dodgy lending. You know, some brokers lending to people that shouldn't get loans. There's some people who, you know, foolishly or being misled take out more money than they can afford to repay. But they are more isolated rather than certainly across the board, and certainly not systemic. I don't believe we have a systemic problem with dodgy lending of the extent we saw in Spain, Ireland, and the United States. And the other thing that happened in those countries is supply. I mean, they had a big run up in prices in those countries, but there was a deluge of supply which basically crushed their housing boom. We've had a pickup in inner city property construction, but supply is still pretty, you know, a decent house with decent land is still very, very scarce in many capital cities, and so we haven't had the deluge of supply. No, I don't think in terms of the Sydney market, I think the Sydney market is getting near a cyclical high. But again, it's not dangerously overvalued. What we've seen in Sydney is a catch up from a number of years of weak growth during the mining boom, the super low interest rates that we've got, and in fact structurally low. So in fact, you know, interest rates are low and they will rise, but in the long run they'll never average what they averaged in the previous 10 years. So you know, the average, you know, mortgage rate over the next 10 years is likely to be only 1%, maybe 2% higher than it is at the moment.
And what about any impact to bank share prices? I mean, is that?
Yeah, look, I think, again, like if you look at the Perth market, like again, Four Corners highlighted the weakness of the Perth market, and like Perth had a mini bubble because of the mining boom. So there was a moment a few years ago where the median price of a Perth property was higher than that in Sydney, and that obviously things just got a little bit got crazy there, and that's why we're seeing a big downturn in their market yet. But if you look at default rates across Western Australia and in Perth, they've picked up, but they're still pretty low. I mean, you're not seeing carte blanche defaults and people just walking away from their mortgages. And so if it's not happening in Perth, it's not in this environment, it's not going to happen around the country to any great degree. So yes, of course, come the next cyclical downturn in the Sydney market, default rates will lift. but they're still going to remain pretty low. And in fact, APRA have done a lot of stress testing in terms of, what happens to banks should default rates pick up. Even if default rates pick up to the levels seen during the in the United States and Spain, and basically, it's a hit to banks, but certainly doesn't threaten their solvency or anything like that. And there's no reason to think we're going to get a spike in default rates to the extent we've seen internationally. Also, don't forget, in Australia, there's if you default on your home loan, the bank takes and you've got equity. You still owe the bank more than what your house is worth. The banks can claim what other equity you've got. It's non-recourse lending. Whereas in the case in the United States, you could default on your home, be underwater, and basically just walk away from the property, and the banks can't claim any other assets. Whereas in Australia, it's quite a different situation.
Mm-hmm. There's actually a few questions on your thoughts about the real unemployment rate, given the sort of government statistics, and the fact that unemployment captures people who are employed for a couple of hours a week.
Yep.
But there's still and the same thing is happening in the States, where there's large numbers of people living on food stamps and that sort of thing.
Yeah, look, good question, and it's true that the unemployment rates in both Australia and the United States probably do understate the level of labour market softness. I mean, that's evident from the fact that we're not seeing any wages growth. The wage pressures are still pretty absent in the United States and in Australia. So in Australia, I mean, the unemployment rate is one measure. Another measure is the so-called underemployment rate, where people who are working part-time that would like to work full-time, if they're not unemployed, but they're underemployed. And so that rate is closer to 10%. And unlike the unemployment rate, it hasn't dropped down over the last few years. So again, a lot of the employment growth in the last few years has been in part-time employment, has been amongst people that probably would prefer a full-time job if they had the opportunity. But yeah, so I take your point. But again, look, overall, the market is still, I guess, has improved.
So bear with me, but it relates to fair value of the US equities market. Mm-hmm. And obviously you think that the market is fair value at the moment, although a number of researchers have come out and said that it's actually very expensive, and returns are looking to sort of decline and even become negative. And the US equities are the most expensive there's been, mm-hmm. save for the 2000 boom.
Yeah.
And then also just an interesting fact that every year ending in 7 has seen a decent correction on Wall Street for the past 100 years. So I wasn't aware of that. That's great. Yeah. Isn't it time to see a reduction in equities there? And I guess well,
look, the equity market is definitely due for a correction. A bear market is a decline of 20%. A correction is a decline of 10% or less. The last pullback in the market has had the market off about 2%, so it's hardly a correction. But I mean, look, in terms of the PE ratio, I mean, yes, look, relative, as I pointed out, the long run average PE ratio in the US is about 15. And some measures on the Schiller PE ratio, for example, it's 15. At the moment, it's above average, but interest rates are historically low. Basically, central banks, rightly or wrongly, have pushed interest rates globally very low, and it's bid up the price of assets all around the world, equities included. In fact, equities are relatively cheap, given where relatively cheap, but I mean, depending on the time frame, but I mean, at worst, I think fairly valued given where bond yields are. So, and we've seen that over the past. The US market PE ratio has held it around these levels pretty comfortably for the past year or so, and it's simply because there's nowhere else to go given where interest rates are. And okay, look, if interest rates go up, if inflation breaks out, all bets are off. But I mean, the global backdrop is one of structurally lower inflation and interest rates, which is going to have to be reflected in the equity market.
Cool. All right. Thank you very much, David. We've got a few other questions, but unfortunately, we've run out of time. So if you have asked a question, we will come back to you directly. And these questions are always a great source of inspiration for David's blog. So keep a lookout for that as well. We do appreciate you joining us, and thank you very much for your time. We will be sending you a copy of the presentation and a copy of the recording today. Thank you very much for joining us, and keep an eye out for the next quarterly economic outlook with David Bassanese.
Thanks very much, everybody.
Thank you.